Welcome to Wall Street Weekly. Today we are doing a deep dive into the week of July 6th to July 10th, 2026.
And what a week to dive into, honestly.
Seriously. And to kick this off, I want you to imagine a titan of global technology, right? Like one of the most recognizable brands on earth.
Okay. Yep.
They step up to the microphone and they announce that their quarterly operating profit just surged by 1,800%.
Which is just, a 19-fold explosion in pure profit. It's almost hard to comprehend.
Exactly. Now, in any normal era of Wall Street, you'd assume that stock would immediately rocket to the moon.
Oh, yeah, it would be up 20% at the bell.
Right. But instead, the opening bell rang this week, and that specific stock crashed nearly 7%.
Yeah, it is. It's just the perfect example of the environment we're in right now.
Welcome to the great split of Wall Street, basically, because looking at the sources from these 5 days, it's like looking at a fractured reality.
It really is this psychological paradox right now. On the surface level, if you were just, checking your portfolio app on Friday afternoon, you saw the S&P 500 casually end the week in the green.
Right. It looked totally fine.
Yeah, it looked like a quiet, profitable, almost lazy summer week in the markets.
Mm-hmm.
But underneath that incredibly thin veneer of stability, we saw some of the most violent rotations of the year.
Not to mention geopolitical shockwaves and some serious interest rate panic.
Exactly. The surface level green number is completely lying to you.
And we have so much to unpack here for you today, because relying on that surface level number means you are flying completely blind.
You really are. You've got this massive artificial intelligence infrastructure build out that is essentially single-handedly fighting off the gravitational pull of a hawkish Federal Reserve.
While at the exact same time, the Middle East is sending literal shockwaves through the global commodity market.
Right. It's a lot of cross currents.
It is. But before we even touch the geopolitical side, I want to start with the structural wreckage we saw in the indices, because the final scoreboard for this week tells a story of two completely different economies.
It is the absolute definition of a bifurcated market. You have to look at the divergence in the closing numbers to really understand how extreme this has gotten.
So let's run through those numbers.
Sure. So the S&P 500 finished up 0.50%, closing at 7,575.39.
Okay.
And the Nasdaq, which is obviously driven by that massive tech concentration, did even better. It gained 0.61% to close at 26,281.61.
Right. So tech looks great. Large caps look fine.
Exactly. But the moment you step outside of that Silicon Valley halo, the picture just deteriorates rapidly.
Because the blue chip Dow Jones Industrial Average actually fell 0.79%.
Yep. And the Russell 2000, which, tracks the small cap segment of the U.S. economy, it took a brutal hit. It dropped 1.05% for the week.
Over a full percent down.
Right. And to really grasp the sheer weight of what's happening, you actually have to look at the Russell 3000.
Yeah, let's explain that one, because for anyone who doesn't track it daily, the Russell 3000 is essentially this comprehensive mathematical composite of the entire investable U.S. equity universe.
Right, it's everything.
It includes the magnificent tech giants, but it also includes the regional banks, the Midwestern manufacturers, the small biotechnology firms, everything.
And that index barely squeaked by with a 0.24% gain.
Which is incredibly telling.
Very telling. Because the Russell 3000 is market cap weighted. That means the larger the company, the more influence it has on the index's final number.
Right, so Apple matters more than a local bank.
Exactly. So the fact that an index containing 3,000 companies only managed 0.25% gain, while the tick-heavy Nasdaq rallied, it proves that the gravitational mass of a few mega-cap tech stocks is literally the only thing keeping the broader market afloat.
Wow.
Yeah. If you surgically remove the top 10 AI and hardware companies from the math, the rest of the market was just drowning in rolling corrections.
I want to dig into that specific pain point, because the small caps in the Russell 2000 losing over a full percent, that is a critical signal.
That's a huge red flag.
There is a structural vulnerability there that a lot of retail investors might not immediately recognize, right? Like when they compare a small cap industrial firm to a giant like Microsoft or Apple.
Right, because it fundamentally comes down to how these companies finance their existence. That is the dividing line right now.
It's all about corporate treasury management, isn't it?
Yes. The cost of capital. Think about a mega-cap tech giant. They are sitting on literal mountains of cash. And when they do issue debt, they often do it by issuing long-term, fixed-rate corporate bonds.
And many of them locked in those highly favorable near-zero interest rates back in, 2020 and 2021.
Exactly. So when the Federal Reserve raises rates today, those tech giants don't feel the pain on their existing debt. Their interest expense is locked in.
Right, they basically built a fortress around their balance sheet.
They did. But a small-cap company in the Russell 2000 doesn't have access to the bond market in the same way.
I mean, they aren't issuing 30-year fixed bonds to global sovereign wealth funds.
They certainly aren't. They are structurally dependent on regional bank credit lines, revolving credit facilities, and crucially, floating rate debt instruments.
Floating rate being the key word there.
Exactly. This means their interest payments are directly tied to benchmark rates, like the Secured Overnight Financing Rate, or SOFR.
So when government treasury yields spiked this week, and, we are going to trace the exact geopolitical trigger for that spike in a moment, the cost of borrowing for those small companies adjusted upward almost in real time.
Immediate, unavoidable hit to their bottom line.
Wow.
Yeah, if a small-cap logistics company has a $50 million floating rate loan and benchmark rates jump, their monthly debt servicing cost spikes instantly.
And that cash goes straight out the door to the bank.
Straight to the bank, which means it cannot be used for hiring, it cannot be used for expansion, and it eats directly into their profit margins.
And the equity market obviously knows this.
Oh, they know it intimately.
Yeah.
Which is why small-cap valuations were instantly punished. The second bond yield started creeping up this week.
Listening to this, it honestly feels like we've got a massive freight ship trying to cross the ocean.
Okay, I like this.
And the mega cap AI tech sector is this state-of-the-art nuclear-powered engine pushing the ship forward at top speed.
Right.
But the small cap and cyclical stocks are these massive metal anchors dragging along the ocean floor, just getting repeatedly caught on the rocky, treacherous terrain of high interest rates.
That is a great visual, and the engine is redlining, having to work overtime just to drag those anchors forward.
So if we look at the sector-by-sector breakdown, we can see exactly which industries were acting as the heaviest anchors, right?
Absolutely. The 11 Global Industry Classification Standard, or GICS sectors, painted a very clear picture of this interest rate anxiety.
So who are the winners and losers?
Well, the clear winners were energy, which was up a massive 3.67%.
Wow.
Yeah. Communication services up 1.30%. And technology up 1.20%.
Okay, and the anchors?
On the losing side, materials dropped 2.10% and industrials fell 1.96%.
Let's trace the causality there for industrials and materials, because these are highly cyclical sectors, right?
Extremely cyclical. Their success is entirely dependent on the physical expansion of the economy.
Like building factories, laying infrastructure, manufacturing heavy equipment.
Exactly. And the sources point to hotter than anticipated wholesale inflation as the primary culprit for their drop this week.
Right, the Producer Price Index, or PPI.
Yes. So wholesale inflation essentially measures the cost of goods before they reach the consumer. It's the price at the factory door.
And when PPI runs hotter than expected, what happens?
It creates a highly toxic environment for capital expenditure in non-tech sectors. Let's trace the mechanics of how this hits an industrial stock.
Yeah, walk us through it.
Imagine a mid-sized industrial firm planning to build a new manufacturing facility. The CFO has a financial model for this project, right?
Okay.
Suddenly, the PPI data comes out hot, meaning the steel, the concrete, and the copper required for the build are now 10% more expensive.
Ouch.
Right. But simultaneously, because inflation is running hot, the Federal Reserve signals they will keep interest rates elevated.
So the loan required to finance this factory is also going to carry a higher interest rate.
Exactly. So the cost of materials goes up, and the cost of the money to buy the materials goes up.
It's a double squeeze on the project's return on investment.
A brutal double squeeze. The project's internal rate of return falls below the company's required hurdle rate.
So the CEO just shelves the project.
They just cancel it. They delay it or cancel it. And when you multiply that decision across thousands of industrial and materials companies nationwide, you get a sudden contraction in future earnings expectations.
Which perfectly explains why we saw institutional money rotating aggressively out of XLB and XLI, the materials and industrials ETFs, this week.
Exactly. But we also saw the financial sector drop, roughly 0.8%.
Now, conventionally, you might think banks would love higher interest rates because they can charge more for loans.
Right. That's the textbook assumption. But it's much more complex than that when you look at how fixed income trading desks have to reprice banking margins in a hawkish Fed environment.
It comes down to the concept of net interest margin, right?
Yeah.
NFI.
Yes, NI. Banks make money on the spread between what they pay depositors and what they charge borrowers.
Okay.
When the Fed signals that they're keeping short-term rates high to fight inflation, banks are forced to pay higher yields on savings accounts and CDs just to prevent massive deposit flight.
Right, because otherwise people will just move their cash into treasury bills.
Exactly. But at the same time, those high rates are suppressing loan demand from those exact industrial companies we just talked about.
Oh, I see. So the bank is paying more for deposits, but struggling to originate new, highly profitable loans.
You got it. That squeezes their net interest margin, which prompts the fixed income desks to downgrade their profit forecasts for the entire banking sector.
So cyclicals and financials are getting dumped. But amidst all this selling, the defensive sectors, real estate, utilities, and consumer staples were eerily quiet.
Very quiet. They actually managed to stay slightly positive.
Yeah, consumer staples eked out a 0.02% gain. But, I mean, there is a glaring contradiction here.
Which one?
They managed to hold steady even though major underlying companies reported terrible physical volume trends. Like PepsiCo literally dropped 3.3% on Thursday.
Right, because their North American beverage and snack volumes are cooling off significantly.
Yeah, people are buying less soda, less snacks, yet the sector didn't break. Why?
This is a textbook example of investors seeking a bond proxy.
A bond proxy. Explain that.
So when institutional investors get nervous about economic growth, when they see factories pausing expansion and loan demand dropping, they look for safety.
Makes sense.
Consumer staples companies sell things people buy regardless of the economic weather.
Huh.
You know, toothpaste, toilet paper, basic groceries.
People still brush their teeth in a recession.
Exactly.
Mm.
But more importantly, these companies pay steady, reliable dividends.
So investors aren't buying the consumer staples sector because they think Pepsi is going to sell record amounts of soda next quarter.
No, not at all. They're buying it purely for the dividend yield, treating the stock like a safe haven bond that will pay them while they wait out the volatility.
They're just ignoring the weak earnings volume from individual companies.
They are, because the overarching fear of macroeconomic instability is overriding individual stock fundamentals right now. The market is just seeking shelter anywhere outside of the economically sensitive cyclical sectors.
Which brings us to the most chaotic sector of the week, energy.
Oh boy, yes.
It was the undisputed winner, up nearly 4%. But as we just established, the industrial economy isn't booming. Factories are pausing construction.
Right, so this surge in energy wasn't driven by organic, roaring demand for fuel.
No, it was driven by a violent, rapidly evolving geopolitical crisis.
And if you were actively trading energy markets this week, the whiplash was severe. I mean, the timeline of how the global energy complex reacted to the Middle East between Monday and Wednesday is a masterclass in how quickly maritime risk can reprice a global commodity.
Let's reconstruct that timeline for you. So on Monday, the market opens with a collective sigh of relief. The OPEC Plus alliance, the cartel of oil-producing nations, they announced they are going to increase output by 188,000 barrels per day starting in August.
Right, so more supply is coming online.
Exactly. And on top of that, diplomatic tensions in the Strait of Hormuz appear to be thawing. As a result, international standard Brent crude falls all the way down to $71.99 a barrel. Everything seems calm.
Supply is supposedly expanding, risk is evaporating. That was the narrative on Monday.
But the global commodity markets are hypersensitive to physical supply chain choke points, aren't they?
Extremely. By Tuesday afternoon and accelerating into Wednesday, that entire narrative violently unraveled.
What happened?
Projectiles struck commercial tankers in the Strait of Hormuz. And then, the definitive catalyst. The U.S. president officially declared that the temporary interim ceasefire with Iran was over.
Just flat out over.
The moment that headline crossed the terminal, the reaction was explosive. We saw an intense short-covering panic in the oil pits.
For anyone unfamiliar with the mechanics of the futures market, there were countless traders who had bet heavily on Monday that the price of oil would continue to drop due to that OPEC Plus production increase.
Right, they were shorting oil.
But when the ceasefire collapsed, those bets became wildly unprofitable. To exit a short position, you were legally obligated to buy the underlying asset.
Right, you had to buy it back to close the trade.
So you have a stampede of traders rushing into the market, forced to buy oil at literally any asking price just to stop their losses.
And that algorithmic panic buying is exactly what rocketed Brent crude up 5.2% on Wednesday alone. It pushed it well over $78 a barrel.
And the most vital metric to extract from this event is not just the outright price of oil, right? It's the divergence between different global benchmarks.
Yes. We really have to look at the physical Brent WTI spread.
Walk us through the difference there.
So WTI, or West Texas Intermediate, is the domestic U.S. benchmark. It is largely landlocked, priced out of Cushing, Oklahoma.
Okay, domestic and landlocked.
Right. But Brent crude is the international benchmark, and it is heavily reliant on seaborne transport.
Ah, this is where the geography of the crisis becomes the actual pricing mechanism.
Exactly. The Strait of Hormuz is the world's most critical maritime oil choke point. When commercial tankers are actively being struck by projectiles, maritime insurance companies immediately skyrocket what they call war risk premiums.
For any vessel traversing the Persian Gulf.
Right, because Brent crude represents seaborne international oil. That massive spike in insurance and shipping costs is instantly baked into the price of Brent.
While WTI, which is safely moving through pipelines in Texas and the Midwest, doesn't carry that same maritime risk premium.
It doesn't, and the data reflects that perfectly. The Brent WTI spread widened massively this week,
Jumping from a $3.44 premium on Monday to a massive $4.60 per barrel premium by Friday.
You are literally watching the real-time cost of global maritime fear being priced into a barrel of international oil. It is a pure reflection of logistical anxiety.
But the fascinating thing about the energy market this week is that while oil was having this explosive, geopolitically fueled renaissance, natural gas completely
But a
collapsed.
disconnect there is wild.
It really is. Henry Hub natural gas crashed 9.40% for the week, plummeting well below the $3 per million British thermal units threshold.
Yeah, off a cliff.
If energy markets are panicking about supply chains, why is natural gas falling like that?
Because domestic natural gas is an entirely different beast. While oil was tethered to international geopolitics and maritime shipping lanes, domestic natural gas this week was dictated entirely by meteorology and local supply metrics.
Right. The U.S. natural gas market in the summer is heavily dependent on the power burn model.
Exactly.
The power burn being the amount of natural gas utility companies need to burn to generate enough electricity to run everyone's air conditioners.
Right. And coming into this week, meteorologists had been predicting a massive, sustained heat dome over the eastern two-thirds of the United States.
So traders had priced in a massive power burn premium, expecting record-breaking demand for cooling.
Yes, but midweek, the weather models shifted dramatically. The forecasts called for much cooler normalized temperatures across the East Coast and the Midwest.
The heat dome evaporated.
And so did the demand narrative.
It just vanished.
Simultaneously, we received the weekly storage report from the U.S. Energy Information Administration, the EIA.
And what did they report?
They reported a massive 61 billion cubic feet injection of natural gas into underground storage facilities. Places like depleted aquifers and salt caverns.
Wow. So we are pumping vastly more gas into the ground than we are burning.
We are. That specific injection left domestic U.S. stockpiles sitting comfortably at 6.6% above the historical 5-year average.
Okay, so you have an incredibly robust, historically bloated supply cushion combined with a sudden evaporation of weather-driven demand.
It was the perfect bearish storm for natural gas, completely and utterly insulated from the chaos happening in the Middle East.
Now, this brings me to a macroeconomic paradox that I think is going to stump a lot of people.
Okay, let's hear it.
We have a sudden collapse of a geopolitical ceasefire, commercial tankers are being attacked, international oil is surging, and maritime shipping lanes are under threat. If you read that in a history book, you would assume gold prices went completely parabolic.
Oh, without a doubt. Gold is the ultimate historical safe haven asset in times of war and crisis.
Right. Yet the S&P GSCI Precious Metals Index actually dropped 0.76% this week. I need you to break down the mechanics of why the ultimate safe haven failed to catch a bid during a geopolitical crisis.
It is a brilliant paradox, and understanding it requires looking past the geopolitical headlines and focusing purely on the mechanics of modern fiat currency and central banking.
Okay, break it down for us.
It all comes down to opportunity cost and real yields. Let's establish the fundamental reality of gold. It is a physical rock.
A shiny rock, but a rock.
Exactly. It yields no interest, it doesn't pay a quarterly dividend, and crucially, it is priced globally in U.S. dollars.
Okay, so it just sits in a vault, and its value is entirely based on what someone else will pay for it in dollars.
Right. Now, trace the causality of the oil spike. When the Middle East crisis caused Brent crude to spike above $78 a barrel, it poured absolute gasoline on the fire of inflation fears.
Because oil is an input cost for basically everything: manufacturing, logistics, aviation.
Exactly. When oil surges, institutional investors immediately assume that headline inflation is going to spike globally.
And when inflation threatens to spike, the market's eyes immediately snap to the Federal Reserve.
Precisely. The bond market instantly reacted to the oil spike by anticipating that the Federal Reserve would be forced to keep interest rates higher for a much longer period.
To suppress this new wave of energy-driven inflation.
Right. And that expectation caused U.S. Treasury yields to surge.
So let's connect those dots. Why does a surging Treasury yield crush gold?
Because of the opportunity cost. If you are a massive institutional fund manager, you can choose to hold gold, which pays you absolutely zero yield. Or you can hold a 10-year U.S. Treasury bond.
Which is suddenly offering a guaranteed risk-free return of roughly 4.5%.
Exactly. As those fixed income yields rise, the U.S. dollar also strengthens heavily against other foreign currencies because global capital flows into the U.S. to capture those high interest rates.
Oh, I see. So a stronger dollar makes gold mechanically more expensive for foreign buyers, suppressing demand, while the high Treasury yields make gold look like a terrible investment compared to a risk-free bond.
That combination is kryptonite for precious metals. The geopolitical crisis didn't cause institutional investors to blindly buy gold for safety.
The crisis caused them to fear inflation.
Right. Which made them anticipate higher Fed rates, which made them aggressively buy U.S. dollars and Treasury bonds.
Which explains the massive institutional redemptions out of physically backed precious metal ETFs. They weren't selling gold because the world felt safe.
No, they were selling it because the mathematics of the bond market made the U.S. dollar infinitely more profitable to hold.
Which brings us perfectly to the architect of those interest rates, the absolute center of the macroeconomic storm, the Federal Reserve.
Yes, the Fed.
Wednesday brought the release of the June FOMC minutes. And this wasn't just any routine release. These were the very first minutes under the newly appointed Fed chair, Kevin Warsh.
The Warsh era of monetary policy has officially begun.
And it began with what can only be described as a deeply fractured committee. The minutes revealed a stark, literal 50-50 split among the voting policymakers regarding the future trajectory of the U.S. economy.
Let's look at the actual policy decision first. They opted to hold the federal funds rate steady in that 3.5% to 3.75% range.
Right.
But the minutes explicitly noted that a few participants actively pushed to hike rates immediately at this meeting.
They cited very specific fears, right? Sticky, persistent service sector inflation, the inflationary impact of new trade tariffs, and the massive, unprecedented energy demands of the AI infrastructure build-out.
It is a committee at war with itself.
Yeah.
Half of the Federal Open Market Committee looks at the softening labor market data and wants to begin cutting rates to engineer a soft landing.
And the other half?
The other half looks at the surging energy prices and the resilient service sector, and they want to hike rates to prevent a second wave of structural inflation.
It's like the Federal Reserve is driving a massive school bus representing the U.S. economy.
I love these analogies. Keep them coming.
Kevin Warsh just climbed into the driver's seat. Half the adults on the bus are screaming at him to slam on the gas pedal and lower rates before the economy stalls.
Right.
And the other half are screaming at him to slam on the brakes and hike rates before inflation gets out of control.
So what does he do?
Because he doesn't have a consensus, he compromises by keeping the bus moving at the exact same tense speed. But what really shocked the markets is that Warsh has fundamentally changed how the Fed communicates with the passengers on this bus.
He really has. He has completely dismantled the apparatus of forward guidance.
Explain how that worked before.
For over a decade, under Bernanke, Yellen, and Powell, the market was deeply accustomed to the Fed explicitly signaling their future moves months in advance.
The Fed essentially provided a map and told the market exactly where they were going and when they planned to turn.
Which allowed algorithmic traders and risk managers to confidently model their portfolios. They knew what the cost of capital would be 6 months down the line.
But Warsh has ripped up that map.
Totally ripped it up. His philosophy is heavily dependent on incoming real-time data. He's no longer forecasting the Fed's long-term destination. He's simply reacting to the economic weather as it hits the windshield.
And for institutional investors, this lack of forward guidance completely shatters their risk models.
It's terrifying for them. Every single monthly inflation print, every single payroll report, now carries extreme binary risk. The market has to guess what the Fed will do, meeting by meeting.
And you can see the absolute chaos this is causing by looking at how different asset classes are pricing in this new reality. We have to talk about the divergence between the VIX and the MOVE index.
It is one of the most bizarre disconnects I've seen in a long time.
For our listeners who focus on equities, the VIX is the classic fear gauge, measuring the implied 30-day volatility of S&P 500 options. When equity traders are scared, they buy put options as insurance, and the VIX goes up.
Right. And the MOVE index is the exact same concept, but for the bond market. It measures the implied volatility of U.S. Treasury options.
Historically, if there is a major geopolitical crisis or a major central bank shock, these two indices spike together.
They are usually highly correlated. If the world is unstable, both stock and bond investors seek protection.
But not this week. The divergence was staggering. The VIX actually ended the week down 3.47%.
While the MOVE index, the bond market fear gauge, surged up 5.76%.
So equity traders were actually removing their insurance policies and getting more complacent, while bond traders were aggressively buying protection and panicking.
Precisely. Fixed income traders were reading those FOMC minutes, analyzing Warsh's lack of forward guidance, watching the conflict in the Middle East spike oil prices, and realizing that the future trajectory of interest rates is completely unknown.
So they pushed the 10-year Treasury yield up to 4.56%.
Aggressively pricing in massive interest rate uncertainty. That is why the MOVE index surged. Bond vigilantes are treating this environment with extreme caution.
But the equity guys, by Thursday and Friday, they had completely shrugged off the Middle East, they ignored the hawkish Fed minutes, and they just assumed everything would be fine. They dropped their hedges, crushing the VIX.
And we see this irrational exuberance reflected perfectly in the valuation metrics. Look at the Shiller PE ratio.
Which, for context, is a cyclically adjusted price-to-earnings ratio that smooths out earnings over 10 years to give a more accurate picture of market valuation.
Right, and it actually rose 0.50% this week.
The Shiller PE is telling a very dangerous story, isn't it?
It really is. It shows that broad market valuations remain heavily insulated at historically elevated levels. Equity investors are acting with complete impunity.
They are so blindly optimistic about the future profit margins and productivity gains promised by artificial intelligence that they're willing to completely ignore the blaring warning sirens coming from the bond market.
The bond market is acting like the adult in the room, terrified of inflation and interest rate chaos, while the equity market has its noise-canceling headphones on, looking only at tech earnings.
It's incredible. They see the treacherous interest rate reef right below the surface, but they firmly believe that the AI engine is powerful enough to plow the ship straight through it without taking a scratch.
That's exactly it.
So the ultimate question is, what exact catalysts in the tech sector gave equity investors so much supreme confidence this week? What allowed them to ignore all of these macroeconomic landmines?
It brings us to the tech saviors. This was a historically significant week for validating the physical build-out of AI infrastructure.
It was a relentless drumbeat of positive capital expenditure validations, wasn't it?
Yes, and it started immediately on Monday morning with Broadcom.
Broadcom announced they are extending a massive multi-billion-dollar custom silicon supply agreement with Apple, locking in their relationship all the way through 2031.
Now, we talk a lot about generic GPUs in the AI space, but custom silicon is a different animal. This is Broadcom designing hyper-specific proprietary chips specifically optimized for Apple's internal hardware ecosystem.
And this announcement sparked a massive relief rally across the entire semiconductor sector.
And it needed to, honestly, because it had to offset some very concerning macroeconomic news from another tech giant.
Microsoft.
Right. Microsoft announced they were cutting 4,800 jobs, representing about 2.1% of their total workforce.
In any other environment, a major headcount reduction at Microsoft would signal corporate belt-tightening and send a chill through the Nasdaq.
But the market barely blinked.
They didn't blink because the Broadcom-Apple deal fundamentally altered the timeline of the AI narrative.
Yes. By locking in a custom silicon agreement through 2031, Apple is signaling to the market that the physical build-out of the AI ecosystem is not a short-term 18-month fad.
It is a guaranteed, decade-long capital expenditure cycle. It established a concrete floor under semiconductor valuations for the entire week.
It proved the demand isn't going anywhere. But Tuesday provided a psychological paradox that I think is the most fascinating lesson in market mechanics of the entire week.
I hinted at this in the very beginning of our deep dive. Samsung, the absolute juggernaut of South Korean tech and a massive player in global memory chips, posted their preliminary Q2 report.
And their operating profit jumped 1,800%, a 19-fold increase to roughly $58 billion.
And yet, the stock crashed nearly 7% in Seoul. From a retail investor's perspective, this defies all logic. If a company I own grows its profit by 1,800%, I expect that stock to be hitting all-time highs.
Of course you would.
Why did institutional capital aggressively dump Samsung after the best earnings report imaginable?
This is the ultimate textbook manifestation of an asset being priced for perfection, combined with the brutal realities of semiconductor market cycles.
Explain that cycle.
Understand this. You have to understand how institutional money managers view the memory chip sector, specifically DRAM and NAND chips. It is a notoriously violent boom and bust cyclical industry.
Because it's essentially a commodity. When demand for servers is hot, chip prices skyrocket and margins are massive.
Right. But eventually, everyone builds too many factories, the market floods with chips, prices crash, and those profits evaporate.
So when a specific market subsector has run up as hot and as fast as AI-driven memory chips have over the past year, hedge funds and institutional investors start playing a hyper-aggressive game of musical chairs.
Exactly. They look at that 1,800% profit surge to $58 billion, and they don't think, wow, what a great long-term investment.
What do they think?
They think, this is the absolute mathematical zenith of the cycle. Profit margins can never possibly get better than this. The only direction growth can go from here is down.
It's the victim of its own impossible success. They hit the ultimate grand slam, and the market immediately priced in the assumption that they will never hit another one.
Exactly. Terrified that these historic margins represent a cyclical peak that cannot be sustained into the third and fourth quarters, institutional capital aggressively locked in their profits by selling the stock.
They wanted to be the first ones out the door before the inevitable cyclical downturn in memory pricing begins. It is a brutal, forward-looking mechanism.
So Tuesday leaves the semiconductor space feeling deeply unsettled, terrified of a cyclical peak. But then Thursday arrives, and Micron Technology steps up to the plate to completely soothe those exact fears.
Micron was the perfect antidote to the Samsung panic, right?
It was. Micron shares jumped 4.5% on Thursday, following a highly optimistic update from their executive team regarding their massive new facility in central New York.
This isn't just any facility. This is projected to be the largest semiconductor manufacturing site in the history of the United States.
And Micron's executives essentially came out and told the market, do not fear a cyclical downturn. The demand we are seeing for high-bandwidth memory in the AI era is so structural, so robust, and so long-term that we are aggressively pulling forward our capital expenditure to build this mega fab.
They explicitly validated the forward-looking demand curve, but even the Micron news was just an appetizer for the absolute grand finale that occurred on Friday.
Oh, Friday was huge.
Friday was the singular event that quite literally saved the week for the broader macroeconomic indexes.
We have to talk about SK Hynix.
For you listening who aren't deep in the weeds of the semiconductor supply chain, SK Hynix is a South Korean chip titan. Crucially, they are the premier global producer of high-bandwidth memory, or HBM.
Which is incredibly important right now.
If you want to build an advanced AI processor like the ones NVIDIA designs, you absolutely fundamentally require HBM to make it work. On Friday, SK Hynix launched a historic $26.5 billion American Depositary Receipt, or ADR, listing on the Nasdaq.
We need to contextualize the sheer gravity of a $26.5 billion public listing. First, let's briefly define the mechanism. An ADR allows U.S. investors to buy shares in a foreign company without dealing with cross-border currency exchanges or foreign brokerage accounts.
Right. A U.S. depository bank buys the underlying shares in South Korea and issues receipts trading in U.S. dollars on the Nasdaq.
It essentially opens up a foreign asset to the massive pool of American retail and institutional capital.
Exactly. But asking the U.S. market to absorb $26.5 billion in a single listing is a colossal, unprecedented test of global liquidity.
Massive test. If the market was genuinely terrified of an AI peak like the Samsung reaction suggested on Tuesday, an offering of this magnitude would have been dead on arrival.
It would have priced at a steep discount, or institutional investors would have simply ignored it.
But they didn't ignore it. They devoured it. The offering was priced at a premium, and the sheer velocity of the buying entirely reversed the fear we saw earlier in the week.
It proved definitively that global institutional capital is still absolutely ravenous for exposure to physical AI hardware.
It was a watershed moment for market psychology. The successful absorption of that $26.5 billion acted like a gravitational tide that lifted the entire tech sector.
NVIDIA jumped 3.8%, just riding the secondary momentum of that validation.
And it was this exact specific injection of optimism that pulled the heavily weighted S&P 500 and the Nasdaq into the green for the final weekly close.
It was an impenetrable shield. As long as the AI capital expenditure narrative remains intact and validated by these massive IPOs, equity investors are willing to look past a hawkish Fed chair and missiles flying in the Strait of Hormuz.
It's wild to watch.
Oh, and just to sprinkle a little extra validation on the broader tech space, Friday also saw Circle Internet Group, the company behind the USDC stablecoin, officially win a U.S. banking charter.
That regulatory green light boosted their shares 5% and provided a massive tailwind for the entire fintech and digital asset space.
But the critical takeaway for you is this. The market survived this week by the absolute skin of its teeth. It relied on a historic, once-in-a-decade, $26.5 billion liquidity event to mask the internal rot happening in the small caps and cyclical sectors.
And next week, that safety net is completely removed. We are heading straight into the teeth of earnings season.
So let's pivot and look ahead to the gauntlet that is the upcoming week of July 13th to 17th, 2026. What are the specific catalysts you need to be monitoring for?
The absolute primary focus is the Q2 earnings kickoff. The baseline expectations are bordering on euphoric. Consensus estimates are currently projecting a massive 23.3% year-over-year earnings growth for the S&P 500.
23.3% year-over-year growth in this high interest rate environment is a towering, almost dangerous expectation to live up to.
It's at a very high bar, and the gauntlet starts, as always, with the financials. Tuesday and Wednesday bring the heavyweights. JP Chase, Bank of America, Goldman Sachs, Wells Fargo, Citigroup, and Morgan Stanley.
With the banks, the devil is going to be entirely in the segment breakdowns, isn't it?
Absolutely. JP Morgan, for example, is looking for a 10% rise in investment banking fees. Goldman Sachs analysts are telegraphing a sharp rebound in their M&A mergers and acquisitions advisory revenues.
Which suggests that corporate America is adapting to the higher cost of capital and returning to deal-making.
Right.
But I'm going to push back here because we just spent the first 20 minutes of this deep dive explaining how small and mid-cap industrial companies are canceling factory expansions because debt is too expensive. How do you reconcile a booming investment banking environment with a regional economy that is choking on high rates? What should we look for in these bank reports to see the real damage?
You reconcile it by looking at the credit quality metrics, specifically from domestically focused banks like Wells Fargo and PNC. You have to look past the glitzy M&A fees and focus on the provisions for credit losses and consumer loan delinquencies.
Oh.
Higher interest rates severely test the durability of corporate borrowers and everyday credit card users. If Wells Fargo reports a massive increase in the reserves they're setting aside for bad commercial real estate loans or defaulting auto loans, that will instantly validate the weakness we saw in the Russell 2000 this week.
We are looking for the fracture point between the wealthy corporations doing M&A and the regional businesses struggling to survive.
Exactly. That is the perfect metric to track. And immediately following the banks, we get the midweek tech test.
If SK Hynix proved the market's appetite is still there, Wednesday and Thursday have to validate the actual execution of the hardware cycle.
We have ASML reporting on Wednesday and Taiwan Semiconductor TSMC on Thursday. These two companies literally hold the entire global supply chain of advanced microchips on their shoulders.
If TSMC reports any slowdown in foundry utilization or advanced packaging capacity, the entire AI narrative we just discussed will violently reprice downward.
It could get ugly fast. We also have Netflix and United Airlines reporting to give us a read on the consumer. But it's not just corporate earnings dominating the week, is it? The macroeconomic data calendar is incredibly dense.
It is an exceptional collision of micro and macro data. On the macro side, all eyes are on the June CPI, the Consumer Price Index release.
Headline CPI is expected to moderate, printing slightly below 4.0%. That headline number will benefit from the fact that energy costs were relatively cool throughout June before this recent Middle East spike occurred.
But the Fed doesn't make policy based on volatile energy prices. They look at the core CPI, which strips out food and energy.
Exactly. And core CPI is projected to remain stubbornly sticky at 2.9%. This stickiness is being driven almost entirely by the services sector and housing costs, specifically owner's equivalent rent, which takes notoriously long to filter through the data.
We also get the Producer Price Index, PPI, and the Retail Sales Report, which is forecast to gain a modest 0.3%.
That retail sales number is going to be fascinating. We'll see if the upper-tier consumer is still stubbornly swiping their credit cards to finance summer travel despite the high cost of revolving debt.
But weaving all of this micro and macro data together is the main event. The Fed chair himself. Chairman Warsh is scheduled to deliver his semi-annual monetary policy testimony to Congress on Tuesday and Wednesday.
This is where you need to deploy absolute critical listening. Remember our earlier discussion. Warsh has eliminated forward guidance. The market is flying blind.
His tone during this congressional testimony is the only compass the market has right now.
And the bond market is already making its own aggressive predictions. Bloomberg rate probabilities currently show an 84% chance of a rate hike in September.
84% probability of a hike. That is a massive shift from just a week ago when it was sitting at 61%. The bond market is essentially daring Warsh to pull the trigger.
They are. During his testimony, you have to listen for what metric he highlights as the primary threat. Will he prioritize cooling the resilient labor pool, which requires more rate hikes? Or will he signal an aggressive, prolonged fight against the sticky service sector inflation by pledging to hold rates steady but elevated for the foreseeable future?
If his tone leans even slightly more hawkish than expected, that 84% probability will solidify into absolute certainty, sending Treasury yields even higher and putting immediate, crushing pressure right back onto those small-cap stocks and cyclical GICS sectors we discussed.
It's a high-wire act. But, as always, we have to look at historical context to balance the doom and gloom.
Structurally speaking, July is one of the most reliable bullish months for equities on the calendar. If you look over the past 35 years, the S&P 500 has averaged a 1.4% price gain during the month of July.
Capital is historically deployed during this window.
So the ultimate question for next week is, will this historically reliable bullish seasonality, combined with the sheer, undeniable momentum of the AI tech giants, be enough to hold up against the geopolitical stress of the Middle East and a potentially hawkish Fed chair delivering hard truths to Congress?
It is the ultimate real-time stress test of the Great Split. Can the few magnificent tech giants carry the weight of an entire struggling, high-rate economy?
Let's bring this all together. The definitive takeaway from the week of July 6th to the 10th is that technology, specifically the physical AI hardware infrastructure build-out, is currently acting as an impenetrable shield for the broader market indexes.
It is actively, stubbornly defying traditional macroeconomic and geopolitical gravity.
While small caps choked on the reality of higher floating rate yields and the bond market panicked over tankers being attacked in the Strait of Hormuz, the sheer gravitational pull of Broadcom's Apple deal, Micron's Megafab, and that colossal $26.5 billion SK Hynix listing pulled the surface-level market to safety.
But I want to leave you with a final thought to mull over, something that builds on exactly that dynamic, but peers into a potential blind spot. We've seen this week that the equity market is treating AI infrastructure like an absolute safe haven.
Right. They're completely ignoring the flashing warning signs in the bond market and the supply chain threats in the Middle East.
But ask yourself this, what happens to the AI build-out if the broader economy breaks? The massive, unprecedented capital expenditures required to build these new AI data centers require vast amounts of cheap electricity and enormous debt financing. What happens if those projects suddenly face a severe credit crunch because the Federal Reserve is forced by inflation to keep rates higher for much longer than anyone anticipated?
Right. What if the cost of capital finally catches up to Silicon Valley? If that nuclear engine of tech stutters, even for a single earnings quarter, and those small cap and cyclical anchors are still dragging heavily along the rocky bottom, what happens to the ship? Does it keep plowing ahead, or does that violent underwater current of interest rates finally grab the hull and drag the entire market down with it?
It's the multi-trillion-dollar question.
That is the exact question you need to keep in mind as we head into earnings season. If you enjoyed Wall Street Weekly's market analysis, subscribe and leave a comment or a review wherever you listen to your deep dives, and follow us on YouTube so you never miss a market update. Thank you for joining us today. Keep questioning the headlines, keep looking for the mechanics under the surface, and we will be right back here with you next week as we continue unpacking the forces shaping your reality.